Welcome to the Deep Dive. Today we're digging into the latest results from a giant in the beverage world, Coca-Cola FEMSA, or KOF. They're the biggest Coca-Cola bottler globally by sales volume.
And we've got a really interesting situation in their third quarter 2025 numbers. There's a bit of a paradox, actually.
That's right, so here's the hook. KOF reported that their total volume, the amount of stuff they actually sold, dipped slightly, down 0.6% compared to the same quarter last year.
Usually selling less product, well, it flags a potential problem, doesn't it? Especially for a company like this.
Exactly. But, and this is the core puzzle we need to unpack for you, despite selling a bit less, their financials look, frankly, pretty good. Total revenue actually went up 3.3%.
And even better if you strip out currency effects, right? It was 4.7% on a currency-neutral basis, so they were clearly getting more money for each unit sold.
They were. And the profitability story is even stronger.
Oh.
Operating income didn't just nudge up, it jumped. A substantial 6.8% increase year over year.
Wow, okay. And majority net income was also up slightly, 0.7%. So the big question for us today is how? How did KOF pull off this, let's call it an operational magic trick? Less volume, but higher revenue and significantly better profits.
It really points towards some very deliberate strategic choices, especially when you hear how the CEO, Ian Craig, framed it. He talked about making progress, sequential improvements, but
But he also mentioned a challenging environment, didn't he?
yeah,
And admitted 2025 was turning out more difficult than expected.
precisely. So when the CEO is kind of managing expectations like that, it tells you the positive results probably weren't just from a booming market. It suggests strong internal execution, efficiency gains.
That makes sense. And there's a big piece of underlying strategy that supports this idea of internal adaptation,
Oh.
their digital push.
Ah, yes, the digital transformation. What's the latest there?
It's a major milestone, actually. The report says over 60% of their entire client base, think stores, restaurants, are now digital monthly active buyers.
60%. That's huge. That has to streamline things like ordering, logistics, sales.
Yeah.
A big efficiency driver long term.
Definitely. Okay, so let's get into the math behind that paradox. Less volume, more profit. It really comes down to the margins and, well, it's a bit of a squeeze internally.
How so? I saw gross profit was up just a tiny bit, 0.9%.
Barely. But the key is the gross margin. That actually went down. It contracted by 100 basis points.
Okay, 100 basis points, that's a full percentage point drop in gross margin. So the immediate profit on the drinks they sold got squeezed. Why?
Well, the report points to a few things. An unfavorable product mix, maybe selling less of the high-margin stuff. Also, more promotions, likely to try and stop that volume from falling further.
Right, trying to keep sales moving.
And then just higher fixed costs. So, yeah, the costs tied directly to the product got tougher.
Okay, wait. If the gross margin shrank by a whole percentage point, meaning their direct costs were hurting them more, how on earth did operating income jump 6.8%? They must have found huge savings somewhere else, right?
Exactly. That's the critical part. The operating margin tells the real success story here. It actually expanded by 50 basis points, reaching 14.3%.
So they more than made up for the gross margin pressure further down the line. How?
Aggressive cost cutting, plain and simple. The company was pretty specific, actually. They highlighted two big areas: much lower freight costs.
Okay, cheaper to move the product around.
And less spending on marketing across the board.
Ah, so if demand is a bit soft anyway, you pull back on advertising and promotion costs, you find ways to ship things cheaper, and that focus on internal efficiency protects the bottom line, even if volume dips a bit.
That's precisely the playbook it looks like they ran. They basically accepted a small volume decline, but were determined to protect, maybe even enhance, the profit they made on what they did sell. It's smart management in tough conditions.
Very smart. But that overall consolidated picture, that 6.8% operating income growth, it hides a really significant split, doesn't it?
Yeah.
Between their different regions.
Oh, absolutely. It's like a tale of two continents, almost. The performance in Mexico and Central America versus South America was dramatically different. It really shows how they have to adapt regionally.
Okay, let's break that down. Where did the pressure come from?
Wow.
Mexico and Central America, their biggest division, right?
That's where the main headwinds were. Volume there fell quite sharply, down 2.7%, mostly driven by Mexico itself and also Panama.
And the reason, what did they blame that on?
Kind of a double whammy. They cited a softer macroeconomic environment. So basically consumers feeling the pinch and buying less, and also just bad weather hitting consumption pattern.
Right, can't control the weather. But slower consumer spending in Mexico, that's a big deal for KOF.
It is, and you see it in the financials for that MNCA division. Total revenues there actually slipped slightly, down 0.2%.
So revenues down, volume down significantly. What about profit in that region?
Operating income just barely grew, up only 1.1%, or 1.2% currency neutral. And the only reason it grew at all was because of those cost savings we talked about.
So lower freight costs. And interestingly, they mentioned a small gain from foreign exchange operations within the region.
Exactly. So Mexico and Central America was really just trying to hold the line, relying heavily on cutting expenses to eke out any profit growth at all.
Okay, so if MNCA was struggling, South America must have been firing on all cylinders to get that overall positive result.
It really was the engine for growth this quarter. Very resilient performance. South America, that includes key markets like Brazil, Colombia, Argentina, saw volume increase by 2.6%.
Okay, positive volume growth there. And the financials.
Very strong. Total revenues in South America jumped 8.7%. And if you look at it currency neutral, it's even more impressive, up 12.5%.
Wow, that's a huge difference compared to MNCA. And the operating income down there.
That soared, up 19.7%, or 20.4% currency neutral. Really robust performance. But there's an important detail we need to mention here.
Okay. Always a footnote. What is it? That nearly 20% jump sounds almost too good to be true organically.
Well, part of it wasn't purely operational. The report mentions a one-time income boost in South America, about 218 million Mexican pesos.
218 million from where?
It was net income from insurance claims related to those severe floods that hit Brazil back in May 2024.
Okay. So an insurance payout effectively boosted the profit number for this quarter in South America. That's important context.
It is. PSDing 218 million is definitely a material amount for that division's quarterly profit. So yes, the underlying performance, the volume growth, that was real and strong. But a decent chunk of that huge profit jump came from this one-off insurance payment.
Got it. So South America performed well operationally, but the headline profit number got an extra lift from that payout. Good to keep in mind.
So summing up the regions, Mexico struggled with volume but saved itself with cost cuts. South America grew volume nicely and got a significant profit boost, partly from operations, partly from that insurance money. A bit of a mixed bag driving the overall result.
Okay, that clarifies the how of Q3's performance. Now let's pivot to the future, because KOF is facing a really significant challenge, particularly in Mexico, a legislative threat.
Yes, this is potentially huge. It's a regulatory issue that could really impact their strategies going forward. We're talking about taxes.
Specifically, excise taxes on beverages in Mexico. What's happening?
Well, the Mexican House of Representatives has already approved a major increase, and it's now waiting for the Senate. If it passes, it's a big deal.
How big? Give us the numbers.
Okay, for sugary drinks, the current excise tax is about POA 1.64 per liter. The proposal nearly doubles that, taking it up to 3.08 per liter.
Wow, nearly double the tax on sugary drinks. That's significant in itself.
But here's the real kicker. The proposal also introduces a new tax, PA 1.5 per liter, specifically on beverages sweetened with non-caloric sweeteners.
Wait, a tax on diet and zero sugar drinks. Seriously?
Seriously, that's the game changer. For years, the industry response to sugar taxes has been, okay, we'll push our low-cal and zero-cal options harder. Reformulation, portfolio shift.
Right. Offer the consumer an alternative that avoids the high sugar tax.
Exactly. But this new proposed legislation in Mexico basically says, nope, we're taxing those too. It targets almost the entire modern beverage portfolio, not just the sugary end.
That completely disrupts the standard playbook for dealing with these kinds of taxes. What's KOF saying about it?
Well, publicly, they're reaffirming their commitment to promoting low and non-caloric options, pushing health and wellness, and, engaging constructively with the authorities. Standard corporate response.
But behind the scenes, this must be causing major headaches. If both your regular and your diet options get hit with significant taxes, your ability to manage volume and pricing gets much, much harder.
It absolutely does. It limits their flexibility dramatically. It's a major hurdle they'll need to navigate if it passes the Senate.
And on top of that specific Mexican tax issue, they're still dealing with broader economic factors, like currency swings.
Yes, that's always a factor for a multinational like KOF. The Q3 results, when consolidated back into Mexican pesos, took a hit from the depreciation of the Argentine peso and also several Central American currencies.
So even if a market like Argentina performs well locally, some of that gain gets lost in translation when reporting in pesos.
Precisely. And that currency drag, combined with higher overall financing costs, is part of why their year-to-date net income is actually down slightly by 0.6%, even though this specific quarter's operating income looked strong.
It's a complex picture. Before we summarize, anything else worth noting, maybe on the corporate responsibility side?
Yeah, a couple of quick points. They highlighted an improvement in their sustainability score. They used the S&P Global CSA up 9 points to 79 out of 100, which is quite good. Shows ongoing focus there.
Important for their reputation and license to operate.
And also very relevant given the recent events. They mentioned mobilizing significant humanitarian aid, water, food, supplies after the really bad floods hit central and northeast Mexico back in October.
Right, being a good corporate citizen, especially crucial when you're facing potentially tough regulatory battles like that tax hike.
Definitely helps build goodwill.
Okay, so let's try and synthesize this for you, our listener. What's the main takeaway from KOF's Q3 2025?
I think the core story is one of operational resilience under pressure. They really showed they could pull levers, especially on cost control and pricing, what they call revenue management, to offset that volume weakness, particularly in Mexico.
And they got a significant boost from South America, where things were genuinely growing, although we have to remember that insurance payment definitely flattered the profit numbers down there.
Right. So operationally quite adept managing a difficult environment. But the shadow looming over them is absolutely that proposed excise tax in Mexico. It challenges their core strategies for dealing with health regulations.
Which brings us to our final thought for you to consider. KOF has done well adopting digital tools, over 60% digital buyers now, and they've proven they can cut costs effectively when needed.
But this potential Mexican tax law is different. It's designed to hit both sugary drinks and their non-caloric replacements. The traditional escape route is being closed off.
So the provocative question is, can KOF's current strategies shifting the portfolio mix, advocating with authorities, actually work against legislation that seems designed to curb consumption of almost all their major beverage types, effectively taxing the entire category, not just sugar? Will they need a fundamentally new approach?
That's the multi-billion-dollar question facing them right now. How do you adapt when the rules target your main adaptation strategy? Something to watch very closely.